Hey guys, Boris Schlossberg from BKT. Good to be with you again this week. So, for the last 2 weeks, I've sort of been buried in my little laboratory trying to refine some of my scalping techniques. One of my biggest problems with the scalping technique I showed you earlier was that it was just really too intense. I had to spend too much time at my screen space. If you blinked, you missed a trade. And a lot of, basically because you were doing so many trades, you were losing a lot, winning a lot. At the end of the day, I was plus 10, plus 15, plus 20, on a good day plus 30. And it was just quite a lot of work for a little amount of points. And I really wanted to develop something that was more leisurely, that allowed me to scalp more on a swing basis, to try to capture some of these highs, some of these lows on an intraday basis without necessarily having to be constantly reacting to price action. So after a lot of experimentation, I basically came up with a setup that I thought was actually going to be much more probable than it turned out to be. But let me show you exactly what I did, because ultimately I think it's going to turn out to be quite successful. So the setup again involves Bollinger Bands, and all the Bollinger Bands do in this particular case is give me a trigger for a buy or a sell. In this particular case, though, what I've done is it's a 5-minute chart, but I'm looking for real extremes. So therefore, I have a 3 standard deviation Bollinger Band on the chart, and then I have a 2 standard deviation Bollinger Band on the chart. Oops, sorry, I just removed it. Let me just put this back on. So we're going to put up 2 Bollinger Bands. 3. I'm going to make this black and relatively dark so you can see it. And then I'm going to overlay a Bollinger Band 2. And it'll become very obvious to you why I'm doing this. Okay. So we have 3 2 bands. And I'm going to zoom in on this just to show you what the actual setup is. The basic idea is this. Price will go to extremes once it goes into the 3 standard deviation Bollinger Band. And then if it bounces back out, if it doesn't spend any time but bounces and closes, the key thing is closes. It doesn't matter if the candle is green or red. The key thing is it's got to close above the 2 standard deviation. That gives me the high probability that perhaps a turn is in the making. So I'm going to take my buy signal right over here. I'm buying on the close of this candle, which is right around here. My stop on all my trades, with the exception of the pound, which really needs a little bit more room, is 10 points. So my stop here is 51, right? But here's where it gets interesting, because I really thought, wow, this thing really catches turns well. It's probably like 60-70% accurate. I should just, trade it 1 for 1. Couldn't be farther from the truth. The more you experiment with the thing, you realize that really it's only 50% accurate. There are many times where this turn setup fails. So what I did is I created a money management technique that I think really optimizes my chances of success. Basically, I trade this with 2 lots. My first target is 10 points up, so 71. But my second target is 20 points up at 81, right? Here's the wrinkle that I put into the setup that I think really makes all the difference. Basically, the moment I'm in the trade, if I make T1, I do not move my break even, my stop, to break even. I keep my stop at minus 10. And the reason why is because I really want to give the trade a lot of breathing space. One of the things you'll realize on a short-term basis is that you're going to have a lot of back and forth between the bulls and the bears as they try to jockey for position. And the bears will try to knock things back down to the bottom. The bulls will try to take it back up. And if you don't allow the trade enough space, you're going to get sometimes stopped out very frequently on just plus 10. Remember, if you're taking 2 lots, you're risking minus 20. So you already have a negative risk-reward ratio if you're trading it in that kind of position. So what I've done is I basically said, okay, I'm just going to give it plus 10, don't move my stop to break even, and then hope my second stop hits to plus 20. Generally, if it's a 50-50 proposition, what happens is the following. Half the time I'm minus 20, half the time I'm plus 30. And that gives me a positive edge. But in fact, if you notice, there are half the time I'm wrong, I'm actually not minus 20. I'm basically at scratch because I'm able to neutralize part of my risk by taking T1 at plus 10. A lot of times the position will simply go plus 10, but it will not go plus 20. So by doing that, I'm already giving myself an extra edge. And hopefully, over a long period of time, this provides a nice, relatively smooth. This trade, for example, takes 1, 2, 3, 4, 5, 6, 7, about 30, 40 minutes per cycle. So you got basically 5, 6 opportunities during the day when you have swings of 30 to 40 minutes of up and down within the currency market that you can take advantage of. Let me show you how this worked in real life and a couple of examples. This was a euro-dollar example. I'm going to remove the trade just to show you the setup. So the first setup here is, again, 3 standard deviation, 2 standard deviation. I go long once I get the signal to above the 2 standard deviation. I got long here. T1 was plus 10. T2 was plus 20. Let's see how that worked out. So obviously here's a classic example. It just, I came in long here. I made my T1, T2, plus 30 on the trade. Further down the road, I think I have another example here somewhere. Oh, wait, this was the last example. Prior to this, I have another example here. Yeah, here's a second example. Let me just take this. In this particular case, you see the candle does not have to be green or red. It just simply has to end up at the 2 standard deviation. That was enough to give me confidence that I wanted to go long on this position, because it basically meant that all the selling power was done. I got long here, T1, T2. Let's take a look how this worked. Okay, so that worked well too. Now, here comes the pound. Let me show you the pound trades. Here's a trade in the pound. This was a situation where I had to make some adjustment. I got long here because obviously we made it, we went to T2, but with the pound, you see the volatility is just too large for a plus 10. I really had to make my stop here at minus 15. Now, granted, that was a lot more risk than I wanted to take, but I felt it was necessary in order for this trade to stay alive. And I was actually quite right, because as you can see, the next candle was lots of vicious volatility to the downside. Had I been minus 10, I would have been stopped out, but I survived the stop, and then T1, T2, boom, boom, boom. In this particular case, of course, I got too impatient. I didn't wait quite for T2. I was plus 18. And I was like, okay, I got to go, because I had to actually leave to go to work, so I didn't wait. Had I waited and been patient enough, I still would have made my T2 over here on the position. But let me just end this by showing you a failure, because you have to appreciate that this setup does not always win. Here's an example. Let me just take off the... I think here's a perfect example. Okay, we end up, again, above 2 standard deviation, but this is what happens quite a lot of times. You will not get any momentum. You just simply get a very weak turn and then a final flush to the downside. And that is why the setup is only 50% accurate quite a lot of times. This is not a kind of situation where you can assume, oh, every time I'm going to make the setup, it's going to be positive. And that's why you have to keep your stops relatively tight. So in this particular case, I ended up with a stop out, and the trade kind of petered out. If you went over here to the short side, as you can see, the short trades are actually much harder to manage than the long trades, because they tend to just basically, I almost never take the first short trade signal, but the second short trade signal you possibly could have taken here, and with 94, your stop would have been actually, like, again, you would have had to have the stop close to minus 15 in order for pound volatility to give yourself some room. And you would have made T1, and I think as far as the pound goes, no, you see, here's a perfect example. You would have made T1. I didn't take this trade because it was the end of the day. T1 over here, you're still staying without moving your stop because of all the spikiness, and then ultimately you would have made T2 as the pound spiked itself down. So with a pound, you really got to give yourself more room, but ultimately I would never risk more than 15 to 18 points on any stop in the pound. If the stop looks too big, simply pass up the trade, because it's not worth it. There are at least 5 or 6 trades a day on any one of the 3 key pairs, the yen, the pound, and the dollar, and the euro dollar, for you to practice some of this setup. So I hope you guys enjoyed this. This is a leisurely way of doing a scalp, and if all things work out right, hopefully you have 5 trades that are plus 30 and 5 trades that are minus 20, and at the end of the day, you've made yourself some nice money. This is Boris Schlossberg wishing you the best of luck over and out for BKT. Hey guys, Boris Schlossberg from BKT. Good to be with you again this week. Last week I showed you the swing scalping setup. Many of you have written back to me saying how much you've enjoyed it. Some of you have said you've made as much as 200 points a day on the strategy. This week I want to show you a better version of it, a 2.0 version of it, because as I warned last week, the one weakness of this setup is a very strong trending trade that doesn't allow for much of a turn. For example, beginning of this week, as you can see the euro-dollar chart, you've had turns that have really gone nowhere. So using the setup as we had it last time, which was go long once the price goes above 2 standard deviations, use a 10-point stop, a 10-point target, and a 20-point target on your position would not have worked in this situation. And the reason why is because every time you made a turn, the turn was actually very weak. It wouldn't even make T1. So you would have basically been stopped out. If you had taken this turn, you would have been stopped out as well. You would have had a series of just continuous stop outs as price dribs until it finally makes a turn over here. It was a very slow death by 1,000 cuts. So I was trying to figure out, is there a way to still trade this setup and avoid these rather long and unpleasant drawdowns? Is there a way to mitigate some of these drawdowns? And I think I found out the way to do it. And one of the things that I realized, first of all, is that we understand that we now trade this only on the euro dollar and only on the dollar yen, and we trade it only if we have a broker that gives us a 2-point spread or better. Ideally, we really want to trade with a broker with a 1.5-point spread. So if any of you are trading on a fractional pip broker where the spread is more than 2, you cannot do this setup. But the key thing that I realized as I was trading the setup is that when price turns hard, it really basically almost never retraces. Let me show you an example of, here's a turn. I think, let's assume that, okay, so here's a price closes at above 2 standard deviations, right? It's 30.60, right? And the retrace is minuscule. It's 4 points, 56. So what I've done is I've decided, this setup would work much better if you tightened your stops and tightened your profit targets. Basically allowing you, it's sort of, the idea is that you're either right or you're out. And what I've done is I've changed the parameters to the following situation. Every time I enter the trade now, my stop is only 6 points. That's right, just 6 points large. My T1 target is also 6 points large. What this does is basically in any kind of a weak situation where we have just a weak turn up, right? A turn up that's sort of very weak and then we have a trace back down, I will make my T1. And that will mitigate my risk, because what that means is once I'm plus 6 on the trade, I now am at 0 risk on the rest of the trade. It just becomes a scratch trade. And the key to making money is twofold. One is to win money, and the second is to basically not lose money. So a scratch, in many ways, is a much more positive trade than, of course, a loss. And I want to have a gradation of trades where I have positive trades, scratch trades, and some small losses. Now here's the final wrinkle that I did for the 2.0 setup that I think really works great. My T2, my second target, is actually plus 18. Remember, in the original setup I had it as plus 20. But in that situation, it was only 2 times reward for 1 times risk. In this situation, it becomes 3 times reward for 1 times risk. And finally and lastly, if the price goes plus 12 in my direction, I move my stop to break even, so I lock in at least plus 6 points. Because my idea is that once we trade plus 12 into the direction, if we're going to retrace all the way back, it generally means that the turn is failing. So now we've really modified the setup to lower our risk, increase our profit potential, and mitigate our risk at a faster pace. And let me show you how it worked in real life, because I traded this a few times this week. Here's the euro dollar this week. Let me just go back. Oops, sorry. Let's find a couple of trades. Okay, so I'm just going to find a couple of trades as I go backwards in the chart, and I'll really expand on them so you can see. Okay, so here's a setup. We see that basically the euro dollar here, I was making a turn trade. As you can see, this trade wasn't a classic trade, because what was happening is a lot of times when stuff runs up, remember I said when I short to the upside, I have a lot more flexibility, because usually the first move to the upside I never take. It's a false break. I always give myself a couple of times of the upside to fail before I begin to take the down, the turn trade here. In this particular case, I took the turn trade over here, and I was I was actually kind of very lucky. But the bottom line is, again, plus 6. We made T1, T2 over here on the trade. Here's a more classic turn. Goes into the zone, comes back out. I shorted here, and this was an example where I basically scratched out. Again, a very good example of where using +6 made me a scratch situation, so I didn't lose any money. Let's go backwards, and I'll show you a couple of better setups. Okay, here's a classic. All right, goes into the 3 standard deviation zone, comes back out. I short over here. Boom, boom. Very clean. Remember, the beauty of this setup is that I'm risking 12, but I'm actually making 24. That's a very, very positive risk-reward ratio, and I'll show you later how that really adds up. So this is euro-dollar on the trades. Let me show you dollar-yen. And again, I want to re-emphasize that I really like trading this much more from the downturn to the upward turn than from the upward turn to the downturn. But, you know, I take trades both ways. This is an example of dollar-yen, where we break the 2-3 standard deviation. I get short here. First break, second break. And again, by taking profit over here, I've neutralized my risk. I'm able to stay in this retrace without any worries, and I take my profit as I go along. Let me see if there's any more dollar-yen trades over here. I think there's some to the back side. No, there's no more dollar-yen trades on this particular thing. I don't have much time because I'm leaving early tomorrow. That's why I haven't had a chance to give you more examples. But as you can see, the 2.0 version definitely creates a much better risk-reward profile. And the proof really is in the pudding, because I want to show you the following things. So this is, I'm going to expand this out a little bit. This is the equity curve for the strategy. Initially experimentation, and then tightening up of the profit. As you can see, this was a drawdown of when price begins to trend downward. It's, ironically enough, this equity curve really mirrors a very strong trending market where turns just simply don't work. So you see how, in this particular case, the equity curve really dripped down. Then we recovered a little bit, and then I finally came along and modified my trading situation. As you can see now, the curve moves way up, irrespective of the price action of the currencies. The curve, the equity curve of my position, is actually doing much better than, let's say, a continuous drip down. Mainly because anytime I have a very, very long continuous trend, and I'm not able to find any kind of turns in the price, I'm basically able to mitigate my situation by being at scratch most of the time. And then when I do catch a turn, I'm +2 to 1. So I think this is a much better version. -6, +6, +18, move stop to break even if it goes to +12, and watch the turns to the downside, because obviously I think those are the better quality turns. I hope everybody enjoys this setup. We're going to trade it a lot more actively next week. I'm going to come back to you with the equity results next week, and hopefully they will really show some very, very serious improvement. This is Boris Schlossberg for BKT, over and out.